Good. So those who will look at the roles of management accountants. Another aspect is governance and control of strategic management. Governance and control of strategic management. That is the third aspect that I'll be looking in respect to the introduction. Another one that we will look at there is the code of ethics. Sometimes we call ethical standards. Ethical standards. My good students, you know that you have encountered these ethical standards at various levels. Normally, we say that integrity, confidentiality, objectivity, those are the ones that we term as ethical conducts. Another one there I'll look at is the installation. Installation of management accounting. Installation of management accounting. In small organizations, we don't expect to have management accountant, but blue chips companies, we must have management accountant as well as financial accountant. But if it is small, you only need financial accountant. So in this case, we will look at the factors to consider to install a MA system or not to install. And that one marks the end of introduction to management accounting, my good students. I can also add the limitations. Limitations of MA. One of which that MA is evolving. You cannot compare MA and financial accountant. MA is just, it is at its developmental stage. So that is topic number one. Topic number two is cost estimation. Cost estimation and interpretation. Cost estimation and interpretation. So at that point, we'll come up with those particular cost connecting equations. I believe we must have encountered some of them in intermediate level. Or sometimes it was in section 2 before the syllabus was revised. Right now, we call it intermediate level. So those cost connecting equations that we normally use as corporate world companies to forecast the future cost of an enterprise. So those particular connecting equations, one is, we call it accounts analysis. Accounts analysis. Whereby, under accounts analysis, we classify costs into two components and use a connecting equation of the form y equals a plus bx. So under that particular method, we classify costs into two components, fixed cost and variable costs only. So that is accounts analysis. Another method that we normally use to forecast the cost is high-low method. Are we together? Winnie and company? Good. Thank you very much. So the next method is high-low method. At the same time, it uses y equals a plus bx. But we normally use 2 points only. We don't use all the observable data. For example, month 1, January to December. We just depict the highest month that we used.
Excuse me, Mwalimu.
Yes.
Kindly mute, because I can't see the board because some people are interrupting.
There is an interruption from the background. Huh?
Yes, so just mute all of them.
All right. Right, so the second method that we use to come up with the future cost is high-low method, and it takes the form y equals a plus bx, whereby you just highlight the highest point in respect to activity level. At the same time, you highlight the lowest point. So that means you have 2 points to come up with what? With a cost connecting equation of the form y equals a plus bx. The third method is called linear regression. Simple linear regression. Also called ordinary least square. Ordinary least square method. Ordinary least square method. This method, it uses all the observable data from January to December, or from January to July. It depends how the examiner gave you, even for 4 quarters. So in that case, we use all the observable data and to come up with the cost connecting equation of the form y equals to a plus bx, using all the observable data. Unlike high-low method, where you use only 2 points. At the same time, we have another method, which is we call industrial engineering. Industrial engineering method, whereby this one does not need any workings. It was advocated by Frederick Taylor, the father of management, whereby to use this method, you must have a clear relationship between input and output. For example, if you cover 22,000 kilometers, there is a certain fuel that you are going to use, maybe, for example, 20,000 per se, 20,000 shillings in respect to fuel. So this industrial engineering, you must use it where we have clear observable data from past experience. There is no computation. So in that case, 2,000 kilometers, you use 20,000 fuel for that matter. So what if you cover maybe 1,500 kilometers? You can be able to detect using that particular concept of Frederick Taylor. Then another method of cost or labor, not labor, but forecasting cost is what we call learning curve. Learning curve is also another cost forecasting function. Sometimes we call nonlinear equation, whereby we know that when an individual is introduced to a particular task for the first time, you tend to take more time and produce less output. Reason being, you are new in that particular job, don't have experience at all. At the same time, you don't have confidence. So the time that you take to produce the first unit will tend to reduce as a result of gaining experience and confidence. So for the first unit, you may take maybe 50 hours to produce a given task. As you produce the second, the third, you gain experience and confidence. So therefore, time reduces as more units are produced. And at that point, we can use a small graph to represent that particular concept of learning curve. And it reduces like that. Time, here is time on the y-axis, and on the x-axis is the output. So time reduces and output increases as a result of gaining experience and confidence. So those are the methods that we'll be looking under topic number 2. Hope we are together. Topic number 3. Topic number 3 is called planning. And decision making. Planning and decision making, topic number 3. So under this topic, decisions. When making decisions, we have 4 types of environments on which we can make decisions. First one, you can say environments of decision making. Environments of decision making. One is under certainty. Under certainty. This is where a decision maker has only one single outcome, meaning there is no comparability between option 1, 2, or 3, so that we can select which one are we going to follow. Under certainty, the decision maker is sure on the decision to make, and it is only one. Like linear programming, it is either to maximize profit or to minimize cost. That is where we encounter certainty. We have a single outcome. Another environment is uncertainty. Uncertainty. This is where now we have more than two outcomes, of which one will be selected. And at that point, the decision maker is not for sure which option to prevail. So in that case, we normally have some models which we impress to give us the best decision. Those models are Maxi, Max-Mini, Laplace minimax regret, I can even say that, minimax regret, and the last one is Howitz. Those are the models under uncertainty. The third one is under risk. Under risk. Under the same under risk, we have models like expected monetary value. Expected monetary value. Next one is expected opportunity loss. Expected opportunity loss. The last one, we can use decision tree. So those are the three under environment of risk. Another environment, there are normally four. Another environment is we have an environment of competition, which we normally call game theory. Competition or game theory. This one is not encountered under this level. So, my good students, we will be concentrating these two. That one will be my concern. Topic one, certainty, or method one, there's no big deal. And the fourth one, competition, which is not tackled at this level. Good. Now we go to topic number 4. Topic number 4, which we call it as before that per se, before that, under planning, we'll be looking at what we call cost volume profit analysis. Cost volume profit analysis is under planning and decision making. Cost volume profit analysis, whereby we look at what point the company will break even, at what point when we will anticipate the number of units for a target profit. So in that case, we'll be looking at environment of single product, called single product, under environment of certainty, and multiple products, where the company is producing 2 or more products. Multiple products, again under certainty. Good. On the same, I look at what we call value of information. We know that if you are uncertain about something to introduce into the market, either a product or a service, you can decide to engage a market researcher or a surveyor to conduct that particular exercise and give you the report, which you can accept or reject. So that means you must pay for that particular exercise. You cannot expect somebody to conduct a survey and there is no fee to pay. You must pay. That is the case, then we will want to look at how much you are capable to pay for that particular information, which we call value of information. Then we look at what we call the applications of marginal costing. We have applications of marginal costing. Whereby we have make or buy. So we have applications of marginal costing. My good people, my good students, marginal costing, it means variable cost. So therefore, making a decision as the topic dictates, you must elaborate, you must scrutinize those costs, and therefore not all costs are relevant for decision making. Right? For example, fixed costs are irrelevant, but marginal cost or variable cost, they are relevant for decision making. So under that particular aspect, we look at make or buy, acceptance or rejection of special order, continue or discontinue, product mix decisions. All of them, they are under what? Marginal costing. That is all about topic number 3. Topic number 4 is pricing decisions. Pricing decisions. And at that point, we'll have different aspects to analyze before you price a product, which we know for product pricing, you must account for material cost, labor cost, and overheads. We know that overheads are costs that we are going to incur for the benefit of many units. You cannot trace overheads to the final product, unlike labor cost, material cost, you can trace. So here we'll be looking at one is the internal pricing. Under internal pricing, which is very interesting, it is where for performance evaluation, we have departments in an organization or divisions. One division is a cost center. Good example, manufacturing. It doesn't sell a product to the external market. It must transfer the units to the sister department, which we can say marketing department, to sell to the external market and bring in profit or revenue. The same case applies under financial reporting, where you account for branch accounting. At the same time, we can account for consolidation, business combination. So if we account for business combination, we ignore intercompany sales because they are not genuine sales. But when we talk about branch accounting, we treat intercompany sales as genuine sales for performance evaluation in respect to departments. The same case applies to management accounting, whereby we have a cost center, which is a production. For performance appraisal, we take into account the intercompany sales as genuine sales for performance evaluation. But when we talk about evaluation the company as a whole, we ignore intercompany sales. So therefore, the production department has to sell per unit with at a fee called transfer price or transfer fee to the sister department. That is internal pricing. Then we have external pricing. External pricing. This is where the company will account for all costs based on the methods. Maybe they can use Y equals to A plus B X like that. Those are the other aspects. Then we also have life cycle. Life cycle costing. Life cycle costing. Meaning that we have to account for the cost that a product will pass through until it is withdrawn from the market. So we have three phases. We have research and development phase, manufacturing phase, and the third one is disposal phase. Initially or traditionally, we were accounting for manufacturing phase only. But as time goes, we say that production cost, apart from production cost, we must have two costs or phases: research and development and disposal. Again, we have another one called target costing. Target costing. It is where you plan yourself. How much are you going to incur in respect to production, and at the same time you compare with the actual results in respect to production. So that's what we call target costing. Are we together, members? Are we following? Dama, Winnie, okay, good. I can see we are following at par. Good. So that is topic number 4. And even we have another one called Kaizen costing. Kaizen costing, and this is a method that has been used by Japanese. It was introduced from Japanese, which is a continuous improvement, and that is the one they normally use under Toyota models, Toyota car models, which we call Kaizen costing. Is an improvement, continuous improvement method. Good. Now we can look at another topic, which is performance appraisal, performance evaluation and measurements. So there we have strategic. Now number 5, strategic performance measurements. So, my good students, as I told you, we have departments in an organization, we have divisions in an organization. Those divisions, they are controlled by divisional managers. If and only if the organization is operating what we call decentralization system. Decentralization. It is where departments in a given company, which has several departments or branches, those departments, we have managers. Those managers can be given autonomy, meaning authority to act on their own. That is decentralization. Another one is centralization, where branches, they are not given autonomy to do their job, meaning everything, if it is material purchases, purchased from the head office, then transported or distributed to departments. Now, if we are operating a decentralized system, those divisional managers, they are given autonomy. And therefore, at the end of the day, we must evaluate, we must measure them. But based on responsibility accounting, that means that divisional manager, you are going to evaluate based on what he or she has control over. Activities, costs, in respect to the division manager has control over. Those ones from the head office, you don't account, you don't include when you are going to do what we call performance evaluation for stewardship purposes and even bonuses. So you evaluate based on what the divisional manager has control over. Therefore, we have methods that we normally use to evaluate these particular divisional managers. One is return on investment. Return on investment. That is the first method that we normally use to measure a divisional performance, which is also called return on capital employed. Return on capital employed, one and the same. The second one is residual income. Residual income, RI, residual income. After we have gotten the profit for the year, we have reinvested, even if we have a project which is viable, whatever remains, that's what we mean as what? Reinvestment, and there is that particular formula. Number three, we have economic value added. Economic value added. It's a way of evaluating the profit which has been generated by these individual divisional managers based on economic aspect. Because we know there's a difference between financial accounting profit and economic value added profit. So under economic value added, we don't deduct items which do not involve movement of cash. Like, for example, bad debts, provision for bad debts. From financial accounting, we deduct those so that we can arrive at the accounting profit. But using economic value added, we don't take into account those particular aspects. Good. Another one is, the last one there is accounting rate of return. Accounting rate of return is also another performance measurement. So those are the four that we'll be looking, and that topic is very short. It will take us, like, for example, one lesson or 1.5 lessons. It's very short. So long as we prepare ourselves, then we will be on the safer side because of time limitation. We have only like 3 months, if I'm not wrong, because our exam is on August, end of August. Good. That is all about topic number 5. Topic number 6 is budgets. And budgetary control systems. And the budgetary control systems, budgets and the budgetary control systems. So those are what we call types of budget. So we will start with types of budgets. We know that budgets are prepared at the beginning of the period, not at the end of the period. Budgets are prepared at the beginning of the period. Okay, all right, no harm, really, no harm, too much. So we'll pull up our socks. So budgets are prepared at the beginning of the period. So that means types of budgets, we have static or functional budgets. These are budgets which are prepared according to the activities the company undertakes. Some of them is cash budget, production budget, material purchases budget, or usage budget, labor budget, all those ones, even overheads budget. That is functional budgets or static. Number two is flexible. Flexible budget is a budget that has been developed after changing the original budget because of natural calamities, which we call unforeseen events. Then the third one is master budget. Master budget. So those are the types of budgets we'll be looking at, as well as the advantages and disadvantages. So those ones are just give us soft copy because those are theories. So when we look at budgetary control systems, when preparing budgets, my good students, there are some systems we normally adopt. So let's look at those systems. The first one is, we can say it is rolling budgeting. Rolling budgeting. So under rolling budgeting, it is where we change or we add or subtract an accounting period after the last one has lapsed. So meaning that if a given company had prepared a budget for 4 months, after 4 months has expired, they can decide to add 1 month, meaning they prepare for 5 months, or they deduct 1 month, they prepare for 3 months. And that's what we mean as what? Rolling budget. It is an addition or subtraction of an accounting period. Next is incremental. Incremental budgeting. More or less the same as rolling, but we talk about incremental, we look at the monetary terms. So if we had budgeted for 500,000 for a given period, after that accounting period has lapsed, we can prepare for 550,000. You can see there is an increment. There is an increment. That is what we mean as what? Incremental budgeting. Another one is activity-based budgeting. Activity-based budgeting. In an organization, we have different activities which are being handled. We can have ordering, production, material movement from stores to production, those activities. Therefore, we can budget for them. For example, we have said if we have an activity which we call as ordering, then we must determine the cost driver in respect to that activity of ordering. That cost driver is what we call number of orders. So to account for ordering cost, you must have what? Number of orders. Material movement, you must have, material movement cost, you must have material movement in terms of numbers. That is what we mean as what? ABB, activity-based budgeting. Then we have what we call zero-based budgeting, which we say it is zero-based budgeting, ZBB. This is where after the previous period has elapsed, we sit down as board members and we prepare a budget starting from scratch. We don't look at the discrepancies or the benefits that the last budget had. So in this case, we prepare from scratch, we prepare from zero. Good. So those are some of the systems that we normally encounter when preparing budgets. That is topic number 6. Allow me to look at topic number 7. Topic number 7, which is inventory control decision. Inventory control decision. Under inventory control decision, my good students, we'll be looking at 2 types of environments. We have deterministic environment and we have stochastic. Stochastic and deterministic. Under deterministic, we'll be looking at economic order quantity as well as economic batch quantity. Under stochastic, we look at simulation, as well as safety stock, which we call probabilistic. Those are the areas that we'll be looking under topic 7. Topic 8, which is theory only. Topic 8 is environmental management accounting. Environmental management accounting, EMA. Environmental management accounting. My good students, companies do not operate in a vacuum. Companies do not operate in a vacuum. They operate in the society. That means it must have that particular aspect of protecting the environment. If it is a manufacturing company, we must have a way on how we must protect our ozone layer, pollution, carbon emissions. We must find a way on how to mitigate, At the same time, we don't incur what we call non-compliance costs from the government. Rules and regulations from the government have to be followed. So we must find a way of whether to recycle those particular carbon emissions or waste products. We don't generate to the river because in the river we have creatures, so that we don't affect those creatures. So at that particular topic, economic and environmental management accounting, those are the areas that we'll be looking at, as well as the external failure costs and the internal failure costs. As a management accountant, what role do you play in respect to environmental management accounting? How will you advise the company? That is the way forward. Then topic here, number 9, that is just emerging issues. Emerging issues. So at that point, my good students, that is how we will curb this particular unit advanced MA. So at that point, let's have a break. Then we come back for the few minutes remaining. Break over how many minutes? Winnie, Mudama, because I've elaborated all about that particular topic. Five minutes, all right. Thank you, Winnie. So after 5 minutes, we come and then I will start with topic number 2. Topic number 1, because it's just the theory. As I have said with others, we said I'm going to send notes on topic number 1. So I elaborated with them, and then we started with topic number 2. So in 5 minutes, I am back. I can see Winnie, you are very, very punctual. I can see you are very punctual, Winnie. And I expect you in the next meeting to be punctual from your end. Thank you very much. Now let's look at topic number 2, which is cost estimation and forecasting. Cost estimation and forecasting, as I told you, I will generate the notes for topic 1, which is just theory. So topic 2, cost estimation and forecasting. So you can say cost estimation is a measure. Cost estimation is a measure. Cost estimation is a measure based on the relationship between 2 or more variables. Cost estimation is an attempt to measure, in other words, is an attempt to measure the relationship between 2 or more variables. The relationship between 2 or more variables. Another point to say, cost forecasting is a way of predicting, the future cost of a farm. Is a way of predicting the future cost of a farm. Is a way of predicting the future cost of a farm. Now, let's look at those common cost estimation and forecasting methods. We start with number 1 is accounts analysis. Accounts analysis method. Accounts analysis method. Then you say, under this method, costs are classified into 2 components. Under this method, costs are classified into 2 components. I can see number is increasing. We are now 4. Mohammed. Hey, where are you? Together with Richard. We have been with Mudama and Winnie. And even Richard came. The left. Okay, so under accounts analysis, we are saying costs are classified into 2 components. That is fixed and variable component. Fixed and variable component. Fixed and variable component. Another point to say, the cost connecting equation will be of the form C equals to A plus BX, or Y equals to A plus BX. Like that, where C stroke Y, that is total cost, or D dependent stroke response variable. Stroke response variable. Then we have A. This is the intercept. Intercept or fixed cost. Fixed cost. B. Variable cost. Stroke gradient. Or stroke slope. BX. Variable cost per unit. Variable cost per unit. Then X alone is the output level or independent stroke predictor variable. Those are the abbreviations of those particular connecting equations. Good, good. Now, Muya and Company, let's look at an example. Let's look at an example. An example or illustration. Let's look at example. You say, consider the following information. Consider the following information. Consider the following information. In relation to ABC Limited, in relation to ABC Limited, a manufacturing company, in relation to ABC Limited, a manufacturing company that produced 15,000 units, that produced 15,000 units in the current period, that produced 15,000 units in the current period. Now, this is the information. So you have direct labor. We have 150 out of 1,500, 1.5 million. That is direct labor. Direct material, direct materials, you can have 2 million. Indirect material, indirect materials, for that matter, you can say 800,000. Then we have depreciation. We have 600,000. Technical support. Technical support, in bracket tunaambiwa 25% fixed. Then the amount there is 700,000. Other utilities. Other utilities. 35% variable, giving us 1.2. 1.2. Rent. $400,000. Rent is 400,000 like that. Then we have general expenses. General expenses. You are told 70%. 7% fixed. And that is 900,000. Good. Required. 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 Roman 1, cost estimation function of the form y equals to a plus bx. Cost estimation function of the form y equals to a plus bx using accounts analysis method. Using accounts analysis method. Using accounts analysis method. Roman 2, the total cost of the farm, if 25,000 units were to be produced, if 25,000 units were to be produced. Good, that is it. So my good students, let us have solved that. So we have column for details, column for fixed cost, column for variable cost. Those three. Details, column, fixed cost, then we have variable cost. Hope you are steady. We start with the direct labor. Direct labor. The amount is 1.5 million. The examiner is silent in respect to either variable or fixed. So it's upon you because you have done management accounting, intermediate level or section 2. So direct labor, do we classify as fixed or variable? The ball is on your court. The ball is on your court. Fixed or variable? Variable. Winnie, thank you very much. It is variable. So you classify direct labor as variable, 1.5 million. What about direct material? Direct material. Is it variable or fixed? Direct material, variable or fixed? Again. Good. We need an variable, which is 2 million. That is very true. Next one there is indirect materials. indirect materials. Again, where are others? Where are others? Mutama. Members, participate members. We need naona pale Mohammed, variable, we need fixed. The correct one is variable. We need indirect is part of variable. So indirect is 800. Put there 800,000. That is variable. Next one is depreciation. Members, Mohammed, Richard. Depreciation. Okay, let us go with Winnie. Depreciation is fixed. Yes, even Mohammed has confirmed. So depreciation is fixed, that is 600,000. Then we go to technical support. Technical support, a portion, you have been told, a portion out of 700,000, 25 is fixed. So 25 is fixed out of 700 times 0.25. 175. 175 is fixed. Variable 525. That is it. Good. Next one is other utilities. Other utilities, 35% variable. So out of 1.2 times 0.35 variable for 20,000. What about fixed? So out of 1.2, 7, 8, 10. 7, 8, 10. Good. 7, 8, 10. What about, are you in any? The other one is 420. 420. Next one is rent. Rent, my good students, rent, variable or fixed? The exam is silent. Correct, we need rent is fixed. It cannot be variable whatsoever. General expenses. Seventy percent fixed. Coming to 70% fixed. 630 is fixed. The remainder 270. Good. So at that juncture, you are getting the totals. Get the totals now from your end. Fixed 2585. About variable, hey, we need very fast. We need sasa we ni class rep. I appoint you to be the class rep. 5515. That is variable. That is it. Mohammed is rent is fixed. Mohammed, rent is fixed from the word go. It rent, you cannot say that rent is variable, meaning that as the number of students you have, for example, in a certain institution varies with the rent. No, rent is fixed. It doesn't vary according to the number of units if it is in production. Mohammed, are we together? Mohammed, confirmed? Right. Now, at that point, we come up with our post-connecting equation. I need to correct rent. Rent, rent. Rent, it is supposed to be fixed. We said rent is 400. Yes. Thank you, Richard. It's supposed to be on the fixed side. We need to correct that. Or we need, is the totals okay? Are the totals okay? Thank you, Mohammed. I've corrected. What about winning? Depreciation. Again, depreciation. Where? Yeah. 600. What am I going? 600 fixed. I'm tired. I had another class. I'm tired. So are the totals okay? Mohammed, I've corrected. Depreciation is supposed to be on the fixed side, the first column. Are we together now? Richard, Mohammed, are we together? Thank you, Richard. Now, are the totals okay? Totals. Confirm the totals. They must be, Winnie. Okay, Winnie saying the totals are okay. Confirm. Mudama, the totals are okay. I'm the one who was writing, having something in mind which is correct, but writing in the awkward column. Okay, if you are saying that the totals are okay, I salute. So at that point now, we come up with our cost connecting equation. Why? equals A plus BX. Y would be equal to A, I told you, is the fixed cost. In this case, it's 2585. 2585,000 plus variable cost 5515. That is the total variable cost. But the function states that BX, meaning I need to get per unit. So that total variable cost, it is 15,000. I need to divide by what was their activity level in respect to this information. What was the activity level? Somebody to just tell me. Richard. No. That is for projection. Richard, that is for projection. What was the initial activity level in respect to the information? I believe it was around 15,000. Try to figure out 15,000. Yes. Richard, 15,000. 15. Hey, Winnie, is it 50? I said 15. So that the projection will be 25. So 15 is the initial output level. I divide by 15,000. So that my connecting equation will be equal to 85,000 plus, what is the division here? Let me have my calculator here. $367.667. That is the connecting equation using accounts analysis. Here in Roman 1. Roman 2. We now project the cost that will be incurred if 25,000 units are to be produced using this function. So it will be 85,000 plus 367.6667 into 15, not 15 this time around, 25,000. So what will be the total cost, somebody? What will be the total cost? Okay, what is the total cost? Yes, bring the figures. Let's see whether they are rhyming. They are not rhyming. They are not rhyming. Times 25,000 plus 25,000. 11, yes. We need plus rate. 11,776 666.67. That is the total cost the company will incur if they produce 25,000 units using that accounts analysis method. Good. Now, up to that point, We cannot start another method because time has expired. So until we meet in the next meeting, which is, I believe it's on Thursday, and you have that particular timetable with you. On Thursday, that is when we start with another method. So at that point, allow me to stop there. Allow me to stop there. My name, CPA Jogash. That is, you can call me, and I will respond. So thank you very much. Thanks for your time, creating your time. Until we meet in the next meeting, have a great evening and a nice week. Bye-bye. Good night to Winnie.